Let's start with a number that almost sounds unreal when you first hear it. 1.8 trillion yuan. That's how much money was pumped into China's financial system in just 2 weeks. And if you listen to the official explanation coming out of Beijing, you'd think this is no big deal. They describe it as routine, seasonal, normal. According to the official story, this happens every year around the Lunar New Year. People withdraw cash, travel, spend money on gifts, bonuses get paid out, and banks simply need extra liquidity so ATMs don't run dry. On the surface, that explanation sounds reasonable. But then you look at the scale. Routine maintenance doesn't usually break records. You don't inject historic levels of cash into the banking system just because people are buying holiday presents. You don't suddenly flood markets with liquidity unless something underneath is starting to grind. If the engine is running smoothly, you don't need emergency oil. Yet that's exactly what we're seeing. While officials say everything is stable, the numbers tell a different story. The system isn't cruising, it's straining. This isn't a holiday cash refill. It looks far more like a quiet rescue operation. China hasn't announced a massive new stimulus program. There were no dramatic press conferences, no headlines declaring a shift in policy. But the money is clearly moving behind the scenes. And the reason they prefer to move quietly is simple. If they openly admit why this cash is needed, confidence cracks. Markets react, investors panic, and the illusion of stability disappears. Because what we're watching right now is something economists sometimes call a liquidity illusion. On the surface, things look calm. The currency seems stable. Stock markets are supported. Officials project confidence. But underneath, pressure is building. The central bank isn't pouring fuel into the engine to make it go faster. They're pouring oil into the gears so the machine doesn't tear itself apart. And to understand how serious this is, we need to look at the timeline. On February 4th, China's central bank injected roughly 800 billion yuan into the system. Huge move, but apparently not enough. Just 9 days later, on February 13th, they injected another 1 trillion yuan. 2 massive liquidity injections in less than 2 weeks. Now here's where many people get confused, because when they hear money injection, they imagine money printing in the American sense. But China's approach works differently. When the US Federal Reserve runs quantitative easing, it usually buys assets, government bonds or mortgage securities, from banks. In exchange, banks receive cash permanently. It's like selling your car. You get money, and the buyer keeps the car. Done. China's method right now is more temporary. They're using something called reverse repos. Sounds complicated, but think of it like a pawn shop. The central bank plays the role of the pawnbroker. Commercial banks walk in holding assets, bonds, loans, collateral, that they can't easily turn into cash right now. Maybe those assets are losing value, or maybe markets are frozen. But banks still need cash immediately to handle withdrawals and daily operations. So they temporarily hand over collateral, receive cash, and promise to buy their assets back later. It's a short-term loan. And this distinction matters, because it tells us something important. The banks aren't necessarily bankrupt. They're stuck. A liquidity crisis means money exists, but it's trapped. Like having wealth tied up in property while you can't pay this month's bills. A solvency crisis, on the other hand, means you're broke no matter what. Right now, China's banking system looks trapped in the walls. Money exists, but it isn't moving. Estimates suggest there's a liquidity gap of around 3.2 trillion yuan across the system. That's the hole officials are trying to fill. And yes, they blame temporary factors, tax payments, bond issuance, holiday spending, convenient explanations. But they hide deeper problems. Because in a healthy economy, money flows continuously. I pay you. You pay someone else. They pay suppliers. The cycle keeps spinning. Economists call this money velocity. In China, that velocity is slowing down sharply. And much of the slowdown traces back to the property sector. For years, real estate drove enormous growth. Developers borrowed heavily. Buyers rushed to purchase apartments. Land values soared. But now the cycle has reversed. Developers struggle to repay loans. Home buyers hesitate to take new mortgages. Projects stall. Cash gets locked inside unfinished buildings and bad debt. And when money stops circulating, banks feel the pressure. So this massive 1.8 trillion yuan injection looks less like stimulus and more like an attempt to refill the reservoir before cracks spread through the dam. But relying on short-term loans to keep the system running creates its own danger. Because eventually, collateral runs out, loans come due, and temporary fixes stop working. It's like trying to treat a gunshot wound with bandages. Liquidity keeps banks alive week to week, but deeper solvency issues remain. And here's where the next problem appears. The cash being injected isn't reaching everyday businesses or households. It's getting stuck at the top of the system. Economists sometimes describe this as pushing on a string. You can pull a string to move something, but pushing it doesn't work. Likewise, central banks can inject money, but if banks are afraid to lend and consumers are afraid to spend, that money just sits idle, which is exactly what current data suggests. Despite enormous injections, inflation remains weak. Consumer prices barely move. Producer prices are falling, and that's alarming. If you inject nearly 2 trillion yuan and prices still decline, it means money isn't transmitting through the economy. The pipes are clogged. This begins to resemble Japan's stagnation after its property bubble burst, but happening at a much larger scale and speed. China is fighting deflation using debt, but debt doesn't always create growth. Sometimes it just delays pain. And when we step back and look beyond February, the pattern becomes even clearer. Even before holiday spending kicked in, January already saw huge liquidity support. In January alone, roughly 900 billion yuan flowed through China's medium-term lending facility. After accounting for expiring loans, that still left a net addition of about 700 billion yuan. So ask yourself, if February's 1.8 trillion was just holiday support, what was January's injection for? There was no holiday then, and this wasn't an isolated move. It marked the 11th straight month of net liquidity injections into the banking sector, nearly an entire year of quiet financial support. Holiday demand doesn't last 11 months. Emergency funding does. And here's another key difference. February's moves were mostly short-term liquidity operations, financial payday loans lasting days or weeks. But the medium-term lending facility provides funding lasting up to a year. Banks are locking in liquidity because they don't expect conditions to improve soon. They're borrowing from the future to survive the present. And this leads to a critical question. Why go through all these complicated liquidity tools instead of simply cutting interest rates? In theory, if growth slows, you cut borrowing costs. Businesses invest. Consumers spend. The economy recovers. Economics 101. Yet China has been reluctant to cut rates aggressively. Because of one major constraint, the United States. Right now, U.S. interest rates remain relatively high. If China sharply lowers its own rates, investors could pull money out of China and move funds into dollar assets, offering better returns. That creates capital flight. And when capital leaves, the yuan weakens sharply. Import prices rise. Financial stability gets threatened. So China's central bank finds itself trapped. They can't easily lower the price of money. So instead, they try to manipulate the quantity of money. They keep rates relatively stable to defend the currency while quietly injecting liquidity to prevent domestic stress. It's like pressing the brake and accelerator at the same time, and the engine starts to smoke. The most worrying sign, however, is still deflation. Despite months of liquidity support, producer prices continue falling. Factories earn less for goods. Profits shrink. Companies cut wages. Jobs disappear. Consumers spend less. Prices fall further. A downward loop. And analysts estimate that even after recent injections, the system still faces over 1 trillion yuan in liquidity shortfall, which explains why markets react strangely. Short-term relief appears when banks survive another week. But long-term confidence remains weak because much of the new money simply services old debt instead of creating new growth. Banks hesitate to lend to struggling developers. Cash piles up unused. Dead money. And understanding where that money ultimately flows is key to seeing why injections aren't solving the problem. Because much of the liquidity disappears into a black hole. And that black hole is China's property sector and local government debt system. For years, local governments funded infrastructure by selling land to developers at rising prices. Developers borrowed from banks, pre-sold apartments, and recycled money into more land purchases. A perfect loop until prices stopped rising. Now developers struggle. Land sales collapse. Local governments lose revenue. Banks face unpaid loans. And just as this crisis spreads, another quiet warning appeared. While attention focused on banking liquidity, officials began discussing support measures for insurance companies, including recapitalization plans worth roughly 200 billion yuan. Why does that matter? Because insurers hold large amounts of real estate debt. When developers fail, insurers suffer losses too, which means authorities are now supporting banks and insurers. Financial stress is spreading, and despite official reassurances, the apparent stability of the yuan depends heavily on strict controls and constant intervention. Which brings us to the next pressure point, one of the most powerful tools still largely unused, the reserve requirement ratio. And that's where the story takes an even more dangerous turn. So let's pick up exactly where the tension builds. The reserve requirement ratio, or RRR, is one of the most powerful tools China's central bank still holds in reserve. This rule determines how much money banks must keep locked away and how much they're allowed to lend out. Lower the ratio, and suddenly banks can release massive amounts of money into the economy. Permanent liquidity, not temporary loans. Real firepower. Analysts have been calling for an RRR cut for months, but the central bank hesitates. Instead, officials keep making tiny adjustments elsewhere, trimming lending rates by a few basis points here and there, tweaking short-term funding tools, rolling over loans. Why all these complicated moves? Because once they hit the RRR button, there's no easy way to reverse it. It's like opening a floodgate. Once water rushes out, you can't simply push it back in. And here's the real fear. What if they release all that money and nothing changes? What if consumers still refuse to spend? What if businesses still refuse to invest? What if confidence is already broken? Then the only result would be a weaker currency and capital fleeing the country. So policymakers are trying to operate with surgical precision. But the patient might actually need major surgery. Because the real confusion at the heart of this crisis is the difference between liquidity and solvency. Liquidity problems are temporary. You're wealthy, but you forgot your wallet at home. You just need a short-term loan. Solvency problems are permanent. There's no money at home either. And right now, large parts of China's economy don't just have wallet problems. They have empty bank accounts. Property developers owe enormous debts backed by assets that are falling in value. Local governments built entire financial structures around ever-rising land prices. Insurance firms bought bonds assuming developers would never fail. Now those assumptions are collapsing, and no amount of short-term lending changes that reality. The recent 1.8 trillion yuan injection buys time. It keeps ATMs working. It keeps markets from freezing tomorrow morning. But it also adds more debt to a system already drowning in it. They're trying to solve a debt crisis with more debt. And pressure doesn't disappear. It builds. If pressure can't escape through growth, and it can't escape through inflation, eventually it escapes through the currency. And that matters not just for China, but for the entire world. Because China is now haunted by a historical example. Japan. In the early 1990s, Japan's real estate and stock market bubble burst. Banks were left holding mountains of bad loans. Instead of letting weak institutions fail and resetting the system, authorities kept them alive with endless support. They became known as zombie banks. Alive on paper, dead in reality. They couldn't lend. They couldn't grow. They simply survived year after year, dragging the economy into decades of stagnation. Japan called them the lost decades. China desperately wants to avoid that fate. But there's a crucial difference. Japan became rich before its crisis hit. China is aging before it becomes wealthy. Time is not on their side, which means these liquidity injections aren't just stimulus measures. They're attempts to freeze the clock long enough to transform the economy. The government wants to move away from real estate and toward advanced industries, ships, electric vehicles, high-tech manufacturing. But transforming a massive economy doesn't happen overnight. So they're stuck in a loop. If they stop injecting liquidity, defaults spread through developers, local governments, and banks. If they continue injecting, debt piles higher and growth weakens. Pressure keeps building. And eventually, that pressure spills beyond China's borders. Because if domestic growth can't recover, China has only one option left: export its way out. Flood global markets with cheap goods, electric cars, solar panels, steel, machinery. To do that effectively, they need a weaker currency. Right now, authorities are holding the yuan steady to prevent capital flight. But economic gravity keeps pulling it downward. If Beijing eventually decides that protecting exports matters more than defending the currency, they could allow a sharp devaluation. And that changes everything. A weaker yuan makes Chinese products dramatically cheaper worldwide. Consumers might enjoy lower prices, but foreign manufacturers get crushed. Factories in America, Europe, and Mexico struggle to compete. Jobs disappear. Political tensions explode. Deflation spreads globally. And trade conflicts escalate. In many ways, the early stages of this are already visible. Tariffs, technology restrictions, supply chain decoupling. The world is slowly splitting into competing economic blocs. China injects liquidity hoping global demand will absorb its production, but other economies are closing doors. So money stays trapped inside China, circulation slows, and stimulus becomes less effective each time. The central bank can inject another $2 trillion next month, $5 trillion later. But if the pipes are clogged, nothing changes. What we're watching is a superpower fighting its own balance sheet. Officials can delay consequences. They can manage headlines. They can hide stress. But they can't escape math. Debts eventually get paid or defaulted. There is no third option. And the real danger isn't a sudden collapse. The real danger is the measures taken to avoid collapse. Because if China ultimately weaponizes its currency to protect its industries, the shockwaves hit every global portfolio. The currency war isn't coming. It's already underway. And the first battles are being fought quietly in bond markets and capital flows right now. Which leads to the question that matters most. How does all this impact your money over the next 6 months? Because the shifts happening now will determine currency movements, trade policy, inflation trends, and market performance across the globe. And understanding those moves early can make the difference between protecting your wealth and watching it erode. So if you want to see exactly how the coming currency battle unfolds and what it means for investors everywhere, stay tuned. I'll see you in the next breakdown.